And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It's another week as we get ready to move into the last, kind of the last half of the month, really those last 2 weeks of September, which actually tend to be the weakest days of September. So we'll see how history plays out. Of course, that's always about averages and those type of things. But typically these last kind of 2 week and a half or so of trading in September tend to be some of the weaker days. And then, of course, we move into October, which is, of course, the beginning of earnings season. Already, S&P analysts rapidly at work cutting estimates to make sure that we're okay for earnings season. So plenty of companies will beat earnings. Got to have that, 80% beat rate of earnings. So we got to get those estimates down. They've been busy at that over the last week. Very sharp cut to expectations for the third quarter. However, expectations for 2025 are still 18% higher. So there is a lot of optimism about earnings growth going into next year. The question, of course, is that all revolves around economic growth. And interestingly enough, historically, when the Fed is cutting rates, earnings decline, they don't increase. So again, but that's usually earnings are declining because the Fed's cutting rates because the economy's slowing, and we'll see what happens this time. But a very interesting analogy to all of this is that, and we'll talk some about this this morning as well, is that historically, when the Fed's cutting rates, they're usually doing it in response to some type of event, whatever it is. And it's interesting, everybody points to 1995 as where we are today, right? Oh, the Fed cut rates in 1995 and it's going to be like today, there was no recession. Well, you got to remember, in 1995, we were just coming out of the bond market crisis and the tequila crisis in particular in 94. And so the Fed was cutting rates a little bit just to try to offset that risk of a further kind of crisis in the bond market. And then, of course, at that time, unemployment's strong, the economy's growing at over 4.5%, and the yield curves were not inverted. The yield curve didn't invert until 1998. And then, of course, we had a recession 2 years later. And in 1998, that's where the Fed started cutting rates fairly rapidly as we got into the recession in 2000. Of course, we had long-term capital management, the Asian contagion, and a lot of other issues. So, it's always important to keep context in mind as to where things are going. And right now, it certainly seems like at the moment that this is the 1995 type event, except for the fact that the yield curve was deeply inverted for 2 years and has now just uninverted. That's the difference between now and 1995. Will it play out the same? I have no idea. We're going to be paying attention to it. But the big question is whether or not the Fed is cutting rates now in anticipation of, and Jerome Powell tried to make this very clear last week, talking about he's trying to be ahead of the curve. But economic surprises have been improving, and we've got a lot of economic data coming out this week we'll be watching. But if that data is getting stronger, then that really doesn't justify cutting rates further. But yet the markets right now are expecting very aggressive rate cuts, another 175 basis points going into the end of the year, so into next year. So that's a pretty aggressive set of rate cuts coming by the Fed in an environment where the economy is strengthening, and that's a bit of a different environment. Remember, in 1995, yes, we cut rates, but then didn't cut after that. The Fed kind of just hung in there with rates at elevated levels for a couple more years before they started cutting again in going into 2000. So again, we'll see if this time is different. We'll see how it plays out. That's going to be the big story. This will be the big question. We got some charts we'll go through this morning as well, just kind of showing some history of Fed rate cuts. We'll talk about what went on back then. But again, just this week's economic data is going to be important to watch. Again, economic surprises have been improving. In other words, the data is coming in stronger than expectations. So we'll see if that continues to carry on, if the economy is beginning to pick up steam. And again, remember, the Atlanta Fed now currently expecting about 3% economic growth for quarter three. If that data keeps improving and getting stronger, then you've got to start worrying about a pickup in inflation, and which would keep the Fed from cutting rates further. So again, there's definitely some risk here to the markets, and you know, that's the important thing. So here's what you need to know before the bell. So on Friday, of course, markets kind of fluttered around on Friday a little bit. We did finish in negative territory on Friday, but just a little bit. And again, not surprising. Friday was the largest options expiration day we've had in a long time. It was several $1 trillion. So it was a very big day of options expirations, which led to a lot of that volatility we saw on Friday. A lot of chopping around, so a lot of buying and selling all day long. But the markets did two things from a kind of a bullish standpoint on Friday, which was, first of all, we broke out on Thursday. We had broken out of all-time highs, and so that was bullish, right? So we had this rate cut on Wednesday. The markets kind of sold off in the negative territory, thought about it overnight, traded sharply up on Thursday. In fact, all the gains for Thursday actually happened. If you take a look at this, if you take a look at that little candle there, let's zoom in here a little bit so you can see this a little closer. So you can see that this candle right here was basically the market opened and closed on Thursday at exactly the same level. And what that means is that on Wednesday night, all the trading happened overnight. So the markets ran up sharply overnight, opened up sharply, finished right where it opened. So if you actually bought at the open on Thursday, you made no money on Thursday. It was all made overnight. Friday, the market sold off a bit. But importantly, what happened on Thursday in particular was that we tested that breakout of all-time highs. So that was very bullish also. So we had this nice retest of that break. Now, if we can hold on to that, now this morning futures are about flat. We need to hold on to this breakout of all-time highs. So again, we had a little slight retest of it. If we could retest it again in the next day or two, hold that breakout level, and then move up above kind of where Thursday's highs were and close there, that would be a good confirmed bullish breakout to all-time highs. That would suggest, of course, that the bull market's still very much intact here, which it is. We haven't had a whole lot of challenge here at the moment in terms of the overall market. But we had talked about this kind of consolidating wedge that the market was building, and so we've now broken out of that to the upside. We're still on a good buy signal here right now. Markets are a little bit overbought, so upside may be a little bit limited here, but there's really no reason to be kind of uber bearish on the markets at the moment or really expecting a much bigger decline. Everything's really kind of just playing along very nicely. We went through a corrective cycle here, pre-election, like we talked about. It came a little bit earlier. We thought the correction would be September, October. It came in kind of late August, really kind of August, September. So it's kind of pulled forward again. But the market did de-risk here going into the election. In fact, hedge fund exposure has been pulled back a bit here heading into the election. So again, a lot of that de-risking had happened a little bit earlier than expected. But now as we get ready to move into the election, we should start to see some positioning for who the expected kind of candidate will be for president, who the market starts to expect. This starts to adjust for those policies. And again, as we're going to kick off earnings season here in the next, really kind of the next week or so, we'll start looking at earnings and whether or not that supports the markets from here. So there's some potential here that we can still see a bit more volatility. Be aware of that. This market could certainly whip around here a bit more. Have another sell-off would not be surprising before the election, especially with earnings and how those come in. But again, just kind of be patient here. Let the market tell you what to do next. But again, no reason to be overly bearish right now. Kind of way the overall market setup is. That's what you need to know before the bell this morning. We'll come back. We'll talk about the history of Fed rate cuts and what's happened historically and potentially what it means now. And we'll go into that. We've got some other stuff to get into today as well. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning. Of course, it's Monday, kicking off another week. Is there a holiday in here somewhere yet? Actually, funny story over the weekend. So my wife loves holidays, and as I've told you before here on the show, my wife loves to decorate for holidays. Holidays are her biggest thing of the year. So, and she makes sure and gets every holiday. She doesn't shortchange Thanksgiving. You know, everybody starts putting up Christmas decorations at the beginning of November. Not my wife. She refuses to put up Christmas decorations until after Thanksgiving. She says, you know, if turkeys are going to commit themselves to the Thanksgiving feast, they need to be honored. And so we have inflatable turkeys that go in front of our house that light up for Thanksgiving. So we celebrate Thanksgiving, and then she decorates appropriately for Christmas. But she doesn't forget, Halloween, which is right around the corner. And so she was very excited over the weekend. So as you may or may not know, I don't know how long you've been listening to the show, but if you've been listening to the show for a while, you know I have two dogs. My dogs' names are Gunner and Sniper. Gunner is about 12 years old now. He's getting up there in years. I feel his pain. Sniper's 3, and he's the brat. But they're kind of medium-sized dogs. They're about 30 pounds each. But they're great dogs, very well behaved, and good boys. And so my wife saw on, I think it was Amazon. Don't quote me for sure, but she saw these 2 dogs on Amazon. They're statues, and they're dressed like ghosts. So they've got the white sheet draped over them with the eye holes cut out, and they light up. And so she was so excited about this because she says, I'm going to get these 2 ghost dogs and I'm going to put them by the front doors. And that way, because we have these 2 glass in our new house, our 2 front doors are solid panes of glass. So the dogs sit in front of the doors and just watch the world outside, the squirrels in particular. And she goes, this would be great because I'm going to put these two ghost dogs on the porch.
And then that way, when our dogs are sitting looking out the window, there'll be 4 dogs looking out on the street. So she's all excited about this. And so she ordered, I was like, honey, you do whatever you want to do. It's your holiday, so you order these. And so she orders these ghost dogs. And they showed up. And they're about this tall. I've never seen a woman more defeated at this moment and more sad than when she opened this box and there was this ghost dog about this tall. And by the way, it didn't light up either, which was even worse. So she is now in the process. She is hunting down ghost dogs. I figure the alternative is she's going to buy white sheets and she's going to dress our dogs up as ghost dogs for Halloween. We'll see how this works out. But I asked her, I said, well, did you read the dimensions? She goes, I didn't have my glasses. I was looking at the picture. More stuff goes wrong in my house because my wife cannot read without her glasses, and she refuses to go get contacts. So a lot of stuff that happens in our household is entirely a guess. I think that comes with cooking and everything else. Because if she can't read it, she's not going to get her glasses because she refuses to wear the glasses. She doesn't like the way they look, right? She won't get contacts because she can't put her finger in her eye. So she just walks around blind half the time. So if you're out driving around with her this morning, be careful. All right. We got stuff to get into this morning. Ghost dogs, among other things. So lots of commentary. Oh, by the way, meant to tell you, I just told Brent this a moment ago. So if you follow me on Twitter, X, whatever they call it today, my handle at Twitter X is @LanceRoberts. Over the weekend, I did a live video with Adam Taggart on his Substack channel. So Substack is now wanting to move into doing more live video streams and those type of things. So this was kind of like a beta test for Substack doing live videos. They're trying to bring on kind of a YouTube type structure to Substack so you can subscribe to people's, podcasts, etc. on Substack. So I had to set up a Substack account in order to do this live broadcast with Adam Taggart. So if you're over on Substack already, you can follow me on Substack now @LanceRoberts, and I'll be posting all of our blogs and newsletters and things that we do. I just published a newsletter from this weekend over there as well. So again, if you are already on Substack, you can just follow me there and get just another resource, access to our blogs, our newsletters, and other things that I'll wind up posting over there. It's all free, but you can but it's @LanceRoberts on Substack. So as well. Just, I don't know why. I've got all these different outlets. I don't know why I have everybody keeps telling me I need to set up these new outlets. So I have them. LinkedIn, Facebook. It's a pain in the butt. I have to post the same thing like 90 times. There needs to be, I'm sure there's probably some app out there. I haven't found it yet that I could just post once and it would just post everywhere.
Oh, there's an aggregator. But the problem is they don't all post the same to the different platforms.
Well, it will, no, the aggregators will work for like a tweet, right? So if I'm doing a tweet, I can use something like Hootsuite or whatever, right. And then, it'll post that tweet over to, Substack, whatever. But if I'm writing a newsletter and posting a newsletter, I have to post, like we have 35,000 people that follow us on LinkedIn for our newsletter. They subscribe to our newsletter on LinkedIn. So I have to post the newsletter on LinkedIn. I post it on our website, and now I have to post it on Substack. I have to post it on Seeking Alpha. So it's a manual process. There's nothing out there that will post the full newsletter and make all the links and all that across that. So there's a $1 million idea for somebody out there to build an aggregator that'll post a newsletter. The full thing, not just the tweet, right? That's already out there. Okay. Well, I've killed this segment, so let me just kill it further. The Washington Post Brent, can you show this chart? Yeah. Leave it alone. Stop moving it. Sorry. So, actually, let me scroll down just a little bit so you get the headline. Yeah. Scientists have captured Earth climate over the last 485 million years. Here's the surprising place we stand out. So the interesting part about this article is that they're trying to say that human-caused climate change or human-caused warming is a big threat to the climate, right? And this is the whole thing, right? This is when we have to drive electric cars and do all these other things that we're doing to help, bring down climate change. It was a very interesting article. I'm going to scroll down just a little bit, but look at the right-hand side of that article of the graph. It's at the lowest level that we've had since like 500 million years ago. In fact, when it was that last vertical line is the extinction of the dinosaurs. So clearly what's going on here in these earlier periods is that there were no humans when there were dinosaurs. So we have this human-caused climate change issue going on. But let me read you a clip from this, because this is a very interesting article. It's in the Washington Post, by the way. It's an ambitious effort to understand Earth's climate over the past 485 million years has revealed a history of wild shifts and hotter temperatures than scientists previously realized, offering a reminder of how much change the planet has already endured in warming at the unprecedented rate of warming caused by humans, but yet the warming in their data was not caused by humans. So just kind of an interesting sideline to all this. The timeline, and here's the important statement, right, in this, is the timeline published Thursday in the journal Science is the most rigorous reconstruction of Earth's past temperatures ever produced. The author, and this is according to the authors, combining more than 150,000 pieces of fossil evidence with state-of-the-art climate models, it shows the intimate link between carbon dioxide and global temperatures and reveals that the world was in a much warmer state for most of history of complex animal life. So again, it's very interesting that their own data is kind of debunks a lot of this other data that runs around, like from Michael Mann and others, that the problem with that data, and I've looked at all this data, is that a lot of this data is from areas that have higher temperatures because the data collection station is, near a city or whatever it is, where you have a lot of concrete, so you have actually just warmer temperatures. And there's more of those data collection centers in areas like that versus a collection center out in the middle of Wyoming. And so that data just swamps the data, and you can't really normalize that or adjust that data to compensate for that. So those data temperatures tend to come out a bit warmer. But again, looking at this data is a good example of it. Showed a very sharp decrease in global temperatures since dinosaurs. So I just thought it was interesting. And then again, this is from the Washington Post. The revelations about Earth's scorching past are further reason for concern about modern climate change is their conclusion. Again, this is kind of pushing this idea that, we need to solve global climate change now, but the data doesn't really support it. So that's in the Washington Post today if you want to read it, or actually over the weekend. All right. We'll come back. Let's talk about Fed rate cuts and what's going on with that, because there's a lot of misconceptions running around right now. Can't tell you how many emails I got over the weekend talking about the rate cut and the coming crisis of this. We'll talk about what history says, and we'll talk about the 1995 comparison that people are mistaking right now as well. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Never remodel a house. Learn my lesson. People warn me going in. They go, don't do this. It's like when I was growing up, my dad would say, don't do that because you're not going to like the consequences. And he was usually right more often than not.
Like plug the fork in the socket.
Yeah. I mean,
The Real Investment Show podcast.
the house has a pool in the backyard and they had AstroTurf for the backyard. So I really don't need a robotic lawnmower for about 2 square feet of grass.
At realinvestmentadvice.com.
No, you need another Roomba for the yard.
Apparently. Apparently.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, speaking of rate cuts, my daughter turned 18 on Sunday. I am really close to a rate cut. She graduates in May. Love you. Happy birthday. You're almost off the payroll. Almost. Got to carry her through high school, so she's almost there. Because she's a September baby, she started a year late, right? So she's just finishing up. But yeah, almost off the payroll. And she called me on Sunday. She goes, I woke up today and I think I figured out what I want to do. And I'm like, great. What do you want to do? She goes, I think I want to be a vet. And I'm like, I think that's awesome. I think being a vet would be fantastic. The problem is that she will never be able to handle the death of a dog. She is a dog lover, more so than probably about anybody else I know. And so we'll see. But she wants to go to Baylor. She wants to be a vet. I'm all supportive of this. She hasn't figured out how much it's going to cost her yet. I'm waiting for that to come up. So she's going to have to figure out how to pay for that, but that's all good. So talk about Fed rate cuts. So a couple of things running around the media right now in general, lots of headline data about the rate cut. What does it mean? Blah, blah, blah. And look, it's interesting right now. The economy's, cooking off on at about 3%. Unemployment is creeped up here a little bit, but still very low historically. Jobless claims are still very low. Inflation's coming down. There's really, and again, the recent economic data has not been recessionary by any stretch of the imagination. You know, even at 145,000 jobs, you're still creating jobs, right? You don't have negative job growth. So there certainly doesn't seem to be a reason for the Fed to do such an aggressive rate cut, you know, at this juncture. Now, first of all, the Fed rate was too high relative to where the economy is relative. You know, you've got 5.5% Fed funds and you've got an economy growing at 3%. You've got 5.5% Fed funds. You've got inflation at roughly 3%. So the Fed rates were too high. They needed to come down to align with economic growth and inflation. So cutting rates wasn't the bad idea, but to do 50 basis points right out of the break, that is normally something reserved for when there's a more immediate crisis. Bring this chart up for me, Brent. So this is a chart of history. This is from Bank of America. And I've replicated this chart numerous times, or they've replicated mine, one or the other. But this just shows you the Fed funds rate versus history. And you'll notice that when the Fed starts cutting rates fairly sharply, it's usually in combination with some type of economic event. What's going on? Either a failure of some sort, a bankruptcy that's of significance, you know, kind of systemic bankruptcies, et cetera. And so, or in line with a recession, an oil shock, something like that, right? So the Fed's cutting rates to potentially offset economic risk and financial risk, right? So credit risk and financial risk. So right now, though, there doesn't really seem to be anything at the moment. Now, a couple of things. First of all, it's easy to look back at history and say, oh, yeah, see, we cut rates there and there was COVID, right? Well, we cut rates in September of 2019. There was no COVID. COVID didn't show up until March of next year, of the following year in 2020. So now, see, we can go back and we can circle it and say, oh, yeah, COVID, right? We cut rates, COVID happened. But it didn't happen until later. And same thing back in the subprime crisis. We were cutting rates in early or late 2007, and the subprime crisis didn't show up until 2008, and we didn't declare a recession until December of 2008. So you have to be careful is that, yeah, well, they're cut rates right now, so everything's fine. Well, we won't know for several more months whether everything is fine or not, right? But the Fed is cutting rates. Now, in 2019, as an example, when we cut rates in September of 2019, there was a repo crisis going on behind the scenes, and we were talking about it here with you guys and saying, hey, there's something going on here. The Fed's cutting rates. We got this repo issue going on. We wrote some articles about it. And then everybody's like, well, nobody could have seen the COVID crisis coming. The COVID was just the trigger. That was the event. There was already stress in the financial markets leading up to the COVID pandemic. So again, we have an environment right now where there's certainly some risk evident of that. And I'm going to come back to that chart here in a second, Brent. We certainly have some evidence of some weakness in the markets. And yes, the Fed's cutting rates. But nothing has showed up yet, right? And so everybody's kind of convinced. Now go back to that chart for me. So everybody's kind of convinced this is 1995. So in 1995, the Fed cut rates. And there didn't seem to be anything going on. As I said earlier at the opening segment, we had just come out of the 1994, the tequila crisis. We had a bond market crisis all at the same time in 1994. And so the Fed was cutting rates to stem that issue a bit. But the yield curve wasn't inverted at that point. There was no inversion of any of the yield curves at that point. Everything was fine. Economic growth was fine. Employment was fine. The economy was doing along. It was just a cut to offset that crisis. So now everybody's looking back to today. They're looking at today's cut and going, oh, well, this is like 1995 where there was this soft landing scenario. It really wasn't a soft landing. There was nothing wrong with the economy. There was nothing to land. The plane was flying at 30,000 feet. Everything's great, right? We just finished up with a bond market crisis. That was the only risk that was going on. And then in 1998, Fed decides that they're going to hike rates again because the economy is doing fine, right? We've got stronger economic growth, we need to hike rates. So they hike rates. The yield curve inverts. You have the Asian contagion. You've got long-term capital management, and the Fed starts cutting rates. And then, of course, you have the dot-com crash. And so now we can look back and go, oh, yeah, well, see, we cut rates, and there's the tech bubble. We can see it clearly right there on the chart. So the big question, okay, now you can move on. So the big question is, where are we today, right? This is the big challenge for investors, and I wish I had the ultimate answer for you. I wish I could just say, oh yeah, well, this is clearly where we are, and this is exactly what's going to happen, etc. And I wish I had that for you, and I don't, unfortunately. But and nobody does. But what we do know is that there are consequences for rate cuts as we go through time. But look, we can look back through history, and Bank of America put out this table as well. And I'll just run through it with you really quick. But there's, what we call soft landings, hard landings, and then credit crisis type events. And they laid out kind of what the market returns were, what the 10-year return was, what the 2-year return was. And what's interesting is that, we go back and we look at soft landings. So 1984, 2019, and 1995. Let's talk about those for a second, right? So these are all very interesting periods. Because, now we're looking back. We're going, okay, the Fed cut rates. Let's look back at history. When the Fed cut rates, what was the return? And so you'll notice that 3 months, 6 months, yields were down. 2-year yields were up a bit. And the S&P 500 did okay over 3 months. But let's go back and talk to those dates. Everybody's like, okay, everything's fine. See, it's just like then. Yeah, okay, but it's a function of time. 1984, October 2nd, 1984. Everything's fine, right? We're cutting rates. Then we have the crash from 1987, 3 years later. It was 36 months later, but you still had a crash that was sparked by the Fed cutting rates. 2019, Fed's cutting rates in July. September, we're cutting rates. We got the repo crisis. And then you have the pandemic in 2020. 1995, soft landing, cutting rates, everything's fine. Then you have long-term capital management, Asian contagion, dot-com crash. So the important thing to take away from this is really there's two important factors to take away from this. First of all, every time the Fed has cut rates, something has happened after the Fed cut rates. Every single time. Including 1995, 1984, and 2019. It just took longer to get there. It didn't just happen in 3 months or in 6 months, right? Or a year. And you see a lot of this data running around right now. And again, I actually posted a chart of this in this weekend's newsletter. And this was another chart by Bank of America. Or actually, sorry, this was a chart by Carson Investment Research. And again, this is that type of analysis, which is, okay, here's all the cuts going back. When the Fed cuts rates at all-time highs, stock market did great over the next 12 months, 100% of the time. Absolutely true. No, and I'm not arguing that data at all. It was absolutely true. However, if I go back and look at every one of those periods, there's a significance of those periods. 1980, right? We're coming out of a recession. 1983, 1985, fine, except we just had the Black Monday in 1987. So again, every one of these periods, 1998, 1991, we were going into a recession. There's something going on with all these. And so yes, over 3 months, over 6 months, maybe even over a year, stocks will do fine. But the Fed is often cutting rates, and that rate cut creates another issue. It just may show up later. So in other words, you don't escape the damage. It just may take longer to get to the car crash. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Get ready to wrap things up. Good. So a couple of good comments in the chat over the break. So by the way, I appreciate all of y'all here being, watching us live on YouTube this morning. If you're in your car driving, please keep both hands on the wheel. Don't try to be in the chat at the same time. It's not safe. But if you're in the chat, I appreciate it. And there was a couple of good comments in the chat during the break talking about kind of the markets and where we are and just kind of this topic we're talking about here. And one was that, this time is not like last time, today is different. And that's very true, right? You go back and look at history, and I showed you that chart of interest rates going back to 1915. And you go back and look at that, every one of those periods were different than the previous period, right? There is every time is different. Today is different than it was in 2019. Today is different than it was back in 2015. It's different than it was in 2000. It's different than it was in 2008. I mean, there's a lot of differences today. Like, for instance, 2008. We don't have the subprime issue today that we had in 2008, right? We've got other issues. So this time is always different, right? The important thing, though, is that outcomes tend to be the same. Now, even that is not a guarantee. This time could entirely be different for a whole variety of reasons, right? And that we do rate cuts and the markets do fantastic, and we just keep rocking on for the next 5-10 years. Sure, that's entirely possible. That's why that's when we spend so much time talking about short-term risk management, long-term outlooks. So, as we talked about before, we like to buy companies that are of fundamental value. They have good, strong balance sheets. They pay a dividend. Those are the companies we like. We also own growth companies for a whole variety of reasons, namely to provide performance. But we have long-term outlooks on those holdings. We plan to hold those stocks for a long time unless something goes wrong, right? If something doesn't work, good examples, as I've told you before, we've bought and sold CVS a couple of times, have failed miserably every time we try to buy this company. Fundamentally, love it. I can make all kinds of fundamental cases why I want to own CVS. I still do, right? It just won't perform. So we have to let it go. But that's the risk management side of the portfolio. So again, long-term outlooks, short-term risk management, and we have to navigate that. So we've got to, and the reason for that is we have to navigate the market we have, not the one that we kind of, expect to have or want to have, right? It's like, I want the market to go down. Great. Okay. But that's not what's going on at the moment. Maybe that happens eventually, but that's not today. So we have to navigate that. And the reason is that we don't know what the future is. And yes, this time is different. It absolutely is. The fundamentals are different. The backdrop is different. Things that are happening in the overall economy, the markets, government spending, debts, deficits, all those are different. Outcomes usually tend to be the same for different reasons. Right? It won't be long. It won't be a long-term capital management. It won't be subprime mortgages. It won't be the Asian contagion. Maybe it will, right? It'll be some other issue that comes up that's unexpected. It's exogenous. The markets aren't predicting it, and it causes a downturn. But then when we see that coming, we'll adjust, right? And that's the whole point. That's when we talk about risk management in the short term, taking profits, rebalancing portfolios, just being aware of what's going on. This is why we write so much stuff. And again, I've said this before on the show. If you're only listening to our YouTube channel, if you're only listening to the show while you're driving to work in your car, I so much appreciate it. Don't think for a moment. Please like and subscribe to our YouTube channel. I very much appreciate that. That helps us, get the show out so other people can see it. But if that's all you're doing, you're missing a lot because we publish all of our research. Everything that we're doing. Our blog, we post 3 blog posts a week. One on Tuesday, it's kind of generally technically oriented. Mike does kind of a highbrow market economic outlook of some sort every Wednesday. On Friday, we do a macro view, which talks about economics. On Saturday, we have our newsletter that goes through the markets, all the market statistics, stock screens, everything else is there to help you manage your portfolio better. So and of course we have the daily commentary that comes out every morning at 7:30 that gives you a market trading update for the day and a couple other quick reads. It's like a 2-minute read. It's very short, but that's every day. So you can go to the website realinvestmentadvice.com, subscribe to all of those or none of them, whatever you want to do. But there's a whole lot of research that we publish that all translates into how we manage portfolios. So if you want to know more about our investment strategy, what we do, what we think, just go to the website, realinvestmentadvice.com. Tons of stuff there for you. I've got an article coming out on this week talking about how to invest, where to invest, tax policies coming from the government. What does that mean for markets? We're covering all of that. So it's all there for you. We may not talk about it on the show, but it's all there for you. So again, when we come back and look at these rate cuts, right? The important thing is to understand that there have historically been negative outcomes. Earnings, as a good example. Right now, earnings estimates are expected to be up 18% next year, but when the Fed cuts rates historically, again, earnings tend to fall. Generally because you have slower economic growth, whatever you're doing, right? So this time could be different. But I will say that Wall Street is very optimistic about earnings going into next year, expecting an 18% increase. That's a lot. Now, again, we will never get 18% because as we go into each quarter, we start ratcheting down those estimates before every quarter. So by the time we get, and here's the problem with this, if you're buying stocks today based on 2025 PEs, go, hey, that stock's cheap. Look at the 2025 PE based on that. Well, you're not getting that. Let's say the PE is at 15 or 10, whatever it is, based on forward estimates. By the time you get there, the PE will be 20 or 25 because the price is going to run up in anticipation of these improved earnings, but then the earnings get ratcheted down. So you wind up overpaying for these companies. This is why it's really important to pay attention to GAAP report. Pay attention to the trailing earnings a lot more than you pay attention to forward earnings. Forward earnings are all the earnings without the bad stuff. That's if I don't have to pay any taxes or payroll, that's what I'm going to earn, right? GAAP reported earnings is what actually was in the pocket, right? Pay attention, much more attention to reported trailing than paying attention to forward operating. And you'll do better over time. So, okay. A couple other things about this. There's another article in the Wall Street Journal this morning saying, sorry, the Fed can't save us from a bear market. This is what I'm talking about. If you're managing your own portfolio, be careful of headlines. Nobody knows if there's going to be a bear market or not. Now, will there be a bear market eventually? Absolutely. But when you read that headline, right, your initial reaction is, oh my gosh, I need to go do something today because we're going to have this bear market tomorrow. And that's not the case. The same thing true with, sorry, if this article read, hoorah, the Fed just guaranteed a bull market, right? Be careful with that one too. Because there are no guarantees in the markets. We just have to navigate what we have. And again, when you take a look at the history of rate cuts, that 50 basis point cut right out of the gate has not always worked out well for markets, but not necessarily in the next 3 months or 6 months or 12 months. Those have been fine. But going forward, not so much. Over the next 2 years or 3 years, things have happened. But again, we don't look that far ahead. Again, most of this analysis is, oh, look, this is, every time the Fed does this, over the next 12 months, this is X. Well, yeah, generally, yeah, because you have a lot of momentum in the markets. We have a lot of price momentum in the markets, a lot of exuberance. The markets are up 20% for the year. That's a lot for any year, right? So we've got a 20% return year right now in the market. So there's a lot of momentum, a lot of enthusiasm. Household allocations are at all-time highs in terms of equities. So that's going to carry you. So this is, we talk about, being in a car, right? And you're in this car that's the stock market, and you're put the car in neutral and you're going down a hill, right? Well, gravity and momentum are going to carry you down that hill. And even when you get to the bottom, where you get to the bottom of the hill and the next hill starts in front of you, you're still going to keep going up that other hill, even though the car is going to slow down, because you've got no power behind it, but the momentum of the car itself will carry you up the other hill, or at least part of the way, depending on the size of the hill. And that's the same thing with the market. Right now, there's a ton of market momentum, right? The market is very optimistic, very exuberant. We've had a decade of above average rates of returns. People are very, very confident about markets. And that can certainly carry us 12 months. Easy. The question is what happens after that 12 months? Where is the market going to be? Where is the economy? And is that momentum going to be able to carry you up over the next hill? Nobody knows. That's why we have to manage our short term while we're investing for the long term. All right. Thanks a lot for joining the show today. Be sure and like and subscribe to the channel. We appreciate it. And we'll be back tomorrow with John Penn. And I'll have a new article out for you in the morning on the website as well, realinvestmentadvice.com. We'll see you then.